Good afternoon, and welcome to Transitioning from LIBOR. The time to get ready is now. I'm Mike Kogler, Principal at Market Alpha Advisors. Market Alpha is a market structure and fintech advisory firm that specializes in providing strategic guidance and subject matter expertise across a broad range of issues affecting the financial markets, including, of course, the LIBOR transition. As many of you are certainly aware, the LIBOR transition brings with it significant challenges to the financial services industry, as well as any firm for that matter that has assets or liabilities referencing LIBOR. The subject matter is highly complex and has implications throughout every part of an organization. Fortunately, we have a distinguished panel of experts to guide us through all of the important issues. Today, we will provide a broad overview of the key considerations you'll need to focus on as we embark on the remaining 2-year journey towards the potential demise of LIBOR. LIBOR is used in many different jurisdictions around the world, but for purposes of today's webinar, we're going to focus mainly on issues related to US dollar LIBOR. We plan to spend the first half of the webinar walking you through the relevant issues regarding the transition, and then we're going to enter into a general discussion amongst the panelists. Towards the end of the webinar, or the latter part of the webinar, we'll offer the ability to ask online questions of the panelists. So please submit any questions you want us to explore in more depth. If we don't get to those questions on the webinar, one or more of our panelists will respond to you directly over the coming days. We will provide a replay option and the ability to download the presentation deck in a follow-up email. Please don't hesitate to reach out to us if you want a consultation or just to chat about LIBOR and its effect on market structure. We're always willing to discuss this topic. Market Alpha is co-hosting this webinar with two of our partner firms, MBAF Certified Public Accountants and Friedman, Kaplan, Seiler, and Edelman. Our panelists are Peter Van Vredenburg, my colleague and fellow principal at Market Alpha, David Moshashvili, a partner at MBAF, and Asaf Reindel, a partner at Friedman Kaplan. Over the next hour, we will explore the strategic, economic, accounting, tax, and legal implications of the LIBOR transition. So with that, I'd like to now have each panelist provide a brief introduction. First, I'm going to hand it off to Peter, my colleague.
Thank you, Mike. I'm Peter Van Vredenburg. I was a managing director at UBS and RBC in the rates business in both the trading and the sales side. I then went to HSBC as the head of global markets treasury for the Americas, as well as their representative for HSBC on the Alternative Reference Rate Committee, the infamous ARC. That's it for me.
David?
Thank you, Michael and Peter. I'm David Moshashvili, a principal here at MBAF based in the New York City office. And we are a top 40 accounting and consulting firm in the US with 12 offices spread across the country. And we work closely with a variety of entities, including financial institutions. And one of the many areas that we can help is to navigate through this complex web of accounting and tax issues related to the transition away from LIBOR. Thanks.
And Asaf?
Thank you, Michael, and hi, everyone. My name is Asaf Reindel, and I'm a corporate partner at Friedman Kaplan, a New York law firm. Relevant to this webinar, I'm a member of our LIBOR Transition Task Force, which is a cross-practice group that we formed to help clients prepare for the expected cessation of LIBOR and to bring or defend against transition-related claims.
Fantastic. So as you can see, we have a very distinguished group of panelists here for the webinar, and this is going to be a very interesting discussion, I am sure. So first, I'm going to hand the webinar over to my colleague Peter, who's going to give you an overview of some of the most important issues related to the LIBOR and transition, and talk a little bit about strategy related to that. So with that, I'll give it to Peter.
Thank you, Mike, and good afternoon, everybody, and thank you for joining us on this webinar. I'm going to give a very brief overview of how we got here, why we got here, why we picked certain rates, and then where should you be as an institution at this stage of the LIBOR transition. So to quickly go over how did we get here, why are the IBORs, in this case US LIBOR, being eliminated, as this is going to be predominantly based on US LIBOR. 2008, the financial crisis, illustrated that LIBOR was a very weak index. This allowed the banks to manipulate the rate. Banks, they manipulated it for their own books, as well as to show their own financial strength or weakness, and mostly to try and show strength, but should have been showing more weakness. The banks paid lots of fines, about 12 billion. Several people went to prison. Class actions came and went and are still coming and going. People are still being sued one way or the other, and being charged. At this stage, we cleaned up the index. ICE took it over. The banks also realized, though, that they didn't want to be part of the contribution to LIBOR anymore, and the regulators also realized that there was that this had to change, and the cat was definitely out of the bag, even though it has stabilized since. So every jurisdiction or regulator around the world that had some LIBOR implications decided that they were going to create committees to figure out how to get rid of this LIBOR. In the end, in the US, this became the ARRC, the Alternative Reference Rate Committee. This was 15 major banks that got together with the Fed to basically start working on what should be the transition out of LIBOR. I just want to mention here that when we got together in this committee, that the Fed's idea was always that this was going to be much more of a 10-year process, and that we were going to transition slowly out of LIBOR, create this new rate, and get people used to it. We now all know that it ended up being a 4-year process, and we're halfway through that process. So who is affected and what is affected with this? And this slide is a very interesting slide, because usually when we think of LIBOR, we think of predominantly derivative securities. But this slide just shows you that it isn't just derivative securities, and because of its money market instruments, loan products, floating rate notes, structured products, a lot of these products are very much integrated into the retail framework of the US as well. And this is what makes this whole subject so very important. If it was just on the derivative security side, we wouldn't worry about it as much, because that's professionals and professionals dealing with each other. But this is very much also illustrates this slide where and how much that LIBOR, as I like to say, it's like water. It has seeped into everything, and this slide really illustrates that. So why all the long faces? Because we have the ARC picked this rate SOFR. My colleague on the panel, Asaf, is going to talk about this a little bit more later as well, for other rates as well. What are the big differences between SOFR and LIBOR? Very quickly, LIBOR is a forward-looking rate, SOFR is backward-looking rate. SOFR is a secured rate, it's secured by US Treasuries. LIBOR is an unsecured rate, so it has some credit implications. LIBOR has a term structure, big point of contention. SOFR at this moment does not have a term structure. LIBOR is set by a panel of banks, i.e. it's a fictitious rate, if you want to call it that, whereas SOFR is an observable rate. Two major points here is LIBOR is controlled by the FCA, so the Financial Conduct Authority. So basically, this was a huge point of contention for the Fed. They don't control LIBOR. This is a very important point for everybody to remember. They cannot ask banks to ask them to continue to contribute to LIBOR, whereas SOFR is regulated by the Federal Reserve. Last but not least, as the graph on the left-hand side shows you, SOFR is very new and still very unstable. As we saw in September of this year, the rate jumped by 300 basis points. it gets explained away that 300 basis points, because it's a daily rate, doesn't have a huge impact. This instability is a huge issue for people to transition out of this. The next slide is a quick date line with the important dates. Bring your attention to 3 of these dates. First and foremost, December 2021, December 31. That's when it's all supposed to come to an end. We will have a discussion about this later to see what we all think might happen at that day. 2 dates I think everybody should be very aware of because they're coming sooner rather than later. March 2020, this is when the FHFA prohibits the home loan banks from adding new LIBOR assets and liabilities maturing past December 2021. So this also means that all the member banks have to start conforming to this. This is a major change for all of them. The other big date is October 16th, 2020. This is when the CCPs, in this case LCH and CME Group, will begin using SOFR for the PAI discounting. So this will be very transformative for especially all the dealers that have cleared versus uncleared business. And this should also create a lot of activity in both the futures and the OTC market for SOFR. So that should be good news for both of those. This next slide is probably my favorite slide because now we're getting into where should you be, what should you be doing? And the first and foremost thing that we at Market Alpha would advise anybody is you need to set up the proper governance structure. Governance is the most important piece, and it needs to be from a very, very senior perspective. This slide shows you as to who is affected within one's firm, and it is everybody. Hence, we got this panel together today because legal and accounting and tax are have huge implications, as you're about to hear, but they're not just the only ones. Your IT department, your market risk department, everybody, and they're all very interlinked. The front office can be talking to clients, but if IT or market risk isn't ready to start accepting those transitions, there's no point doing it. I can't reiterate enough that this slide is the slide every firm should be looking at and realizing that you cannot give this issue, this transitional issue, to just one of these areas. You can't just give it to the treasurer or to your IT department. It has to be done across all of these at a very, very senior level. My last slide shows you also, how to look at this problem. Is you can't think about, what rate are we going to use and how is this rate going to work? That is much more in a phase 3, phase 4. We are still very much in phase 1. What is phase 1? Again, at Market Alpha, we advise phase 1 is setting up the proper governance structure, which is very then closely followed by understanding all your documentation. You have to digitize all your documentation to fully understand it. We have partnered up with Pendo Systems. Pendo Systems specializes in the LIBOR transition and the digitization of your documentation. This then allows you to realize what do you have, where do you have it, and then to start making strategic decisions, which is really your phase 2 and 3. So from my perspective, this has to be done. Digitize your documents, and then you can move on. That's it from me for now, Mike.
Thanks, Peter. That was a great overview and a great start to the webinar. One question I had for you, obviously preparing for the LIBOR transition is a complex process, and you've addressed a lot of those issues. If I had to put you on the spot, Peter, what would you say the main takeaways are for people listening today on this webinar?
Yes, Mike, I would just reiterate the same thing, Mike. It's you have to set up the governance structure. You have to make sure, that every area within your firm understands how they are implicated by this LIBOR. What are their risks? What do they have to do? What are the implications? If you just think of from the treasurer's perspective, they have to start figuring out how to transition away from LIBOR in their entire thought process, in their, how they look at their funding, how they look at their asset implications, how they look at their internal transfer pricing. That's all based on LIBOR at this stage, and we're moving away from that. And secondly, Mike, it comes back, is you have to engage with someone to digitize your documentation. And then within that digitization, if you do have someone is then the expertise, even if you've digitized it, is understanding what does that mean? Can we put it into the right categories? You have to categorize all your trades, all your securities into different levels of, we need to transition this out now, we want to get rid of it, etc., etc. That would be my suggestions.
Fantastic. That's a great overview. Thanks, Peter. So with that, I want to transition to some of the accounting and tax implications of the LIBOR transition. And fortunately, we have David Moshashvili, who is a CPA and principal at MBAF, and I can't think of anyone better to talk about these accounting and tax issues. So with that, I'm going to hand it over to David.
Thank you, Michael, and thank you again, everyone, for joining us today. There is obviously a lot to digest here, as the implications of the transition away from LIBOR are profound on a number of fronts. As Peter indicated, there are a number of issues to consider related to the transition. So over the next few minutes, I will give a quick high-level overview of current U.S. GAAP guidance surrounding contract modification accounting, and also touch on some of the tax implications as well. This is clearly a very complex topic, and you'll find that there's a lot of information in the slides which I won't be able to go through in great detail given time constraints, but I wanted to make the information available for your reference nonetheless. The key point here is that as loan and debt instruments are modified to replace LIBOR with another reference rate in response to the transition, current U.S. GAAP and tax rules require an analysis to determine whether such modifications are significant enough changes to the economics of the legacy debt instrument that it should be treated as potentially having been extinguished and a new contract having been created. Basically, based on both U.S. GAAP and tax rules, if an instrument is deemed to have been significantly modified, in this context as a result of replacing LIBOR, there could be significant P&L impact, as well as unintended taxable events that entities will have to deal with. So on this slide, in the context of hedge accounting, as with debt instruments, replacing LIBOR with another rate could result in what is referred to as a de-designation of the hedge relationship and the P&L event as a result of significant changes to the terms of the instruments. From a tax standpoint, if a hedged instrument is significantly modified due to a change in the reference rate, then the deemed termination of the hedged instrument may cause a corresponding gain or loss from the hedge itself, which of course could result in a tax event. I'm not going to spend a whole lot of time on this slide, other than to mention that the transition will also have impact on a number of other areas, particularly in the context of valuations and impairment testing, where LIBOR may have been used as an input. And I think in general, valuations of instruments is going to become a big issue for entities. So as you can imagine, in addition to being onerous both operationally and financially, these matters could lead to significant earnings volatility and unintended tax consequences for a number of entities. So with all of this being said, what are the regulators and governing bodies doing about this? So just last week, the Financial Accounting Standards Board, or the FASB, approved the issuance of an accounting standards update, which was proposed back in September to provide entities with optional temporary relief from having to apply current U.S. GAAP guidance related to contract modifications and hedge accounting, and allow entities to treat modified contracts as continuation of existing contracts. However, this relief can only be applied if the modifications to the terms of the instruments meet certain criteria, which we will discuss in a minute. What makes this relief temporary is that it will not apply to contract modifications and hedging relationships entered into or evaluated after December 31st, 2022. So what this essentially means, and this is a key point, is that to the extent modifications to instruments necessitated by reference rate reform are not made by December 31st, 2022, entities will likely not be able to take advantage of the relief approved by the FASB. And by the way, while the FASB was pondering this, the SEC expressed similar views in July of this year with respect to hedge accounting, where it indicated that it would not object issuers continuing to apply hedge accounting if modifications were strictly a result of reference rate replacement. So now that brings us to the criteria that must be met for modification accounting relief guidance to be utilized. It is important to note that the relief guidance is still very much a moving target until the final version is issued in 2020. And there are a number of inconsistencies and contradictions in the proposed guidance from the FASB. However, what the FASB is essentially getting at is that modifications to the terms of the instruments must be a result of replacing the reference rate and not due to economic or other factors such as, for example, the credit risk of the counterparty. Another example here would be that if a spread is added to the replacement rate, such as SOFR, to compensate for the difference with LIBOR, that spread must not have been driven by any consideration other than replacing the LIBOR. So in this context, any contemporaneous changes to other terms which are not directly replacing the reference rate, but that do potentially change the amount and timing of contractual cash flows must be related to the replacement of the reference rate. And so this is one of the many areas of the relief guidance that I would expect entities to struggle with given the ambiguity. So that brings us to this slide, which I'm not going to go through in detail, but is essentially a laundry list of modifications that are deemed to be unrelated to the rate replacement and which would not be permitted in the context of FASB's relief guidance. And as you can see, it's quite a list. Just a quick note here on this slide for entities that are subject to governmental accounting standards, that the FASB has also come out with proposed relief and is currently accepting stakeholder comments, which are due by November 27th of this year, which happens to be next week. So it remains to be seen what the final product will look like from FASB's standpoint. So as we've discussed, in addition to US GAAP matters, there's been a lot of concern related to the tax implications of the transition as well. In response to these concerns, just last month, the IRS and the Treasury issued proposed regulations that detail the requirements for the rate replacement to not result in a taxable event, and they're asking for comments from stakeholders through November 25th of 2019, which happens to be Monday of next week. So the proposed regulations also contain transition guidance on other matters potentially impacted by the rate change, such as maintenance of the REMIC status and others, and these are all issues that were raised by stakeholders. So while this may seem as a sigh of relief, there are certain scope limitations to be aware of. In particular, in order to avoid a taxable event, taxpayers replacing LIBOR with a new rate, such as SOFR, will need to satisfy 3 tests, which I won't go through in detail, but are included in the slide deck. And again, this is another area, given its complexity, that will likely pose significant changes for taxpayers. And to sort of wrap up, just a few key takeaways here. Again, identify instruments that are affected by GAAP issues and tax issues, consider tax implications, and again, determine whether the modifications are meet the criteria that has been presented and approved by the FASB. And keep in mind the relief is temporary, so you really have to get ahead of the game here and get your instruments looked at as soon as possible. Thank you.
Well, thanks, David. That was a great overview of all of the accounting and tax issues. So quick question for you. You spoke about the relief that has been approved by FASB and the Treasury, but does that mean that stakeholders can now rest easy and not worry about their instruments that are tied to LIBOR?
Well, Michael, that's a great question, and I think a lot of stakeholders may feel that way. However, it's important to note, as I mentioned in my slides, is that the relief is temporary, and it does contain a number of criteria that must be met in order for it to be applied. So, as I mentioned, for example, from a GAAP standpoint, the reference rate replacement must be, and any modifications to any other terms must be tied specifically to replacing the LIBOR. So it's critical to talk to the experts to make sure that any modifications that are made to existing contracts meet that criteria, both from a GAAP as well as from a tax standpoint, in order to be able to take advantage of the relief.
Great. Thanks, David. Thanks for that. So now that we've gone through the accounting and tax issues, we want to talk now about the significant legal implications of the LIBOR transition. And we have Asaf Reindel from Friedman Kaplan, who is an expert on this topic. So with that, I'm going to hand it over to Asaf.
Thank you, Michael. So we focused so far this webinar on a transition away from LIBOR, and Peter mentioned SOFR as a proposed replacement for LIBOR. And I want to focus in the next few minutes on some of the other alternative benchmarks that are being proposed, and also talk a little bit about fallback provisions. So one thing to note about this proposed alternative is that it may very well be the case that the market will settle on a number of replacement rates, not just one, perhaps for different instruments or segments. So, we'll start with the one Peter discussed earlier in this webinar, and it's the main alternative being proposed, the one recommended by the ARC, the Alternative Reference Rates Committee in the US, which is the Secured Overnight Financing Rate, or SOFR. It measures the cost of borrowing cash overnight collateralized by US Treasury securities in the repo market. It's published daily by the New York Fed since April of 2018, so not that long ago, and it requires spread adjustment to adjust for the difference between SOFR and LIBOR. Peter mentioned some of the differences between SOFR and LIBOR, one of them being that LIBOR, unlike SOFR, reflects bank credit risk, which some participants like, because that means that LIBOR goes up in a crisis, whereas SOFR may not. So one proposed benchmark that does reflect bank credit risk is the second one here, the US dollar ICE Bank Yield Index, proposed by ICE, the current administrator of LIBOR. And it's designed to measure the yields at which investors are willing to invest US dollar funds in large internationally active banks on a wholesale unsecured basis over 1, 3, and 6 month periods. It's based on transactions in the primary as well as secondary markets. So we mentioned one advantage, which is reflecting bank credit risk. Among its disadvantages are that it's not published yet, and there's actually no guarantee that it will be published, even though ICE does expect to administer it and provide it in the second half of 2020, although that's subject to some conditions. It's also based on relatively few transactions, so if you're worried about manipulation, that does create some manipulation risk. And for this and perhaps other disadvantages, in July of this year, ICE proposed a potential update to the methodology, whereby the index is determined by combining a term SOFR yield curve and a bank credit spread curve based on transactional data. So what that is trying to do is combine the best of both worlds, a SOFR base plus a bank credit risk component, and we'll see how that is received. The third proposed rate listed here is Ameribor, or the American Interbank Offered Rate. It's based on overnight unsecured lending, mainly between smaller regional US banks. It's published on the American Financial Exchange. It's based on transactions. It's actually gaining some traction. So it may not be a replacement for everything LIBOR, but it may be useful for a segment of the market. And the fourth one here, referred to as zombie LIBOR or synthetic LIBOR, is a scenario in which at the end of 2021, when the LIBOR panel banks are no longer required to make their LIBOR submissions, some of them may continue to do so voluntarily. And it actually seems increasingly likely that that is going to happen, at least for some period. But it's important to remember at that point, LIBOR will be different. It will be based on fewer submissions. It's likely to be more volatile, more uncertain. The UK Financial Conduct Authority is expected at that point, or maybe even sooner than that, to declare that LIBOR is no longer representative. So it is going to be different, and that creates some grounds for potential disputes. You can see a situation where one counterparty to an instrument claiming that this is the LIBOR, it's called LIBOR, it's published where LIBOR used to be published, whereas the other counterparty might say, no, but this is not LIBOR, it behaves differently, it's calculated differently. So, when the General Counsel of the New York Fed stated that the LIBOR transition is a DEFCON 1 litigation event, this may be a good example of that. So moving on to fallbacks. And when we talk about the fallbacks or fallback provisions, we refer to the contractual provisions that state what happens when LIBOR is unavailable. In the derivative derivatives market is developing fallbacks for inclusion in its standard definitions based on the compounded setting in arrears rate. For legacy contracts, those are the contracts that exist today and existed before July of 2017, is they will also publish a protocol to allow market participants to include the fallbacks within the LIBOR contracts if they so choose. So that contemplates a protocol, and if both counterparties signed into the protocol dictates what happens, it's fallback provisions. But if either one did not, then it's up to the parties to agree on how to handle it. In the cash markets, for new cash instruments, the ARC published recommended fallback provisions for 5 different instruments. These are floating rate notes, syndicated loans, bilateral business loans, securitizations, and adjusted rate mortgages just recently. The important thing to remember is these fallback provisions, which are a little bit different for each type of instrument, are not meant to be just copied and pasted into your document. They're meant to be tailored to your transaction, and you should consider doing that, especially if you're a borrower on a loan, because they tend to be pretty lender friendly. And also consider whether they conflict with some of the other provisions that you have in your document, whether it's your form agreement you're using or an agreement you're amending. I actually published an article recently about one such standard provision that seemed to conflict with the ARC fallback provision, and this is the one where lenders can suspend LIBOR lending if they determine that LIBOR no longer adequately and fairly reflect their cost of funding. So if you're interested to read about that, you're welcome to go to our website. In the legacy cash, for legacy cash instrument, these are actually, these present the most challenging situations. There's no one size fits all solution. Take, for example, a floating rate note with a pretty typical fallback provision that says when LIBOR is unavailable, you use the last LIBOR rate quoted. But that contemplates LIBOR not being available for maybe a couple of days, not permanently. When LIBOR goes away permanently, that turns your floating rate note into a fixed rate note, and that's certainly not what the parties intended. Consumer products are also, in such sort of tough legacy category. So that's why it's really important, especially for the legacy instrument, to understand the exposure early, know what the fallback provisions say, if there are any, what the other relevant contractual terms provide, and have a plan to remediate. And there may actually not always be a solution for these legacy instruments. So on the next slide, let me just mention briefly, without going into this, but on the important issue of disclosure, just to say that LIBOR transition is a key risk the SEC is monitoring. And there was this useful SEC staff statement on LIBOR transition published in July. So if this is in any way relevant to you, I encourage you to go ahead and read it. Thank you.
Great, thanks, Asaf. So, Asaf, you mentioned in one of your slides that there might not always be a solution to the LIBOR transition to fallback language in legacy instruments. So in that scenario, what solutions do you see out there?
Yeah, that's a good question, Mike. So, you already see credit agreements being amended. So an amendment is certainly one way. Notes can be bought back. You can do a buyback. So each type of instrument is different. Within a type, there are different inconsistencies. The important thing is that there, and I mentioned there's no clear solution sometimes. There are instruments, for example, like securitizations that require 100% consent to amend, and that's very difficult, if not sometimes impossible to do. We just seen an example of that recently in October when the American Money Management Corp asked investor in one of its CLOs to agree to new LIBOR fallback provisions as part of a refinancing. And one investor apparently refused, and the attempt failed for 2 of the 5 tranches. So that shows how it is very difficult and why early preparation really is so important to understand where the exposure is and try to address it early. And I just mentioned, there's less regulatory focus on the legacy contracts, so it's really mainly up to the parties to resolve it, and that again goes to the early understanding of your exposure and having a plan.
Well, that's great. Thanks, Asaf. With that, we want to open it up to questions from the audience, as well as getting into a little bit of an open discussion on what the issues are amongst our panelists. So, in order to start that off, why don't I kick it off with the first question? So, and I'll pose this to my colleague Peter. So, Peter, for those organizations that are just beginning to prepare for the LIBOR transition, now obviously there are some organizations that have done some preparation beforehand, before this point in time. But if you're an organization that sort of is aware of this, but is just really getting into now formulating a strategy or understanding what's going on with the LIBOR transition, how should they begin the process? What are the first steps that they should take in order to prepare for this LIBOR transition?
Thank you, Mike. As I stated before, I think if you're starting to think about this right now, it is making sure that you have the right governance structure, making sure that all the people within your firm start understanding what you're doing. I think one of the most amazing parts about this whole transitional thing is the amount of LIBOR and LIBOR products still being traded today by everybody. I would say that the volume of LIBOR hasn't tailed off at all across any product at this stage. So set up your governance structure. As I mentioned before, it's then the digitization of your documents, because you also now want to start understanding what are you still trading. Is a simple example of it is, Mike, if you have two trades where the economics are the same, let's say that it's some note and you're receiving LIBOR plus 150 on two notes, but one has what we would classify, or a SAF would classify as good fallback language, and the other has no fallback language. Those two trades should not trade at the same level anymore. The economic value of those isn't just LIBOR plus 150. They are now very different. So you need to start understanding all your documentation, and that goes for your existing trades, i.e. which trades do you want to start getting rid of are going to be more difficult in the transition. But it's also just as crucial now is for any new trades that you're going to add onto your books, that you start understanding what is the value of those. So anybody that's trying to look at this governance structure to make sure that everybody is on board and understands this is what we need to do from your IT to everybody else, and then start understanding your documentation, i.e. call Pendo systems, we'll come along, we will start explaining to you what does that mean.
Thanks, Peter. So just to be clear, you touched on it with your answer there, but just real quickly, just to be a little more specific, what can firms do to measure and evaluate what their LIBOR exposure is? I think you touched on it, but just a little more detail on that.
Mike, it's understanding it, and it's categorizing it, right? You have to understand it's the hard part of this whole transition is you have to go find all the documents. Your trading systems very rarely will represent what you now need to look for. What is the fallback language? What are the tax implications? What are the trades? You need to start putting trades into categories, and those categories are different from a legal perspective, from an accounting and tax perspective, from an IT perspective. So you have to truly understand from the back end, what do I truly own at this stage, and what am I still putting on my books? The oldest saying in the book, Mike, is if you don't know who the idiot in the market is, it's more than likely you're the idiot. This is a prime example of it here, where if you get caught out and people start selling you stuff because the front-end economics look very attractive, right? But suddenly you realize that these trades are going to be really, really difficult to transition later. That's going to be a huge problem down the road for you.
Makes sense. Thanks a lot, Peter. That was a very good explanation and a good overview of the big issue. So, David, I want to pose a question to you. So, you mentioned in your remarks that the accounting relief that FASB is providing is only going to last until December 2022. What does that mean? What does that mean for, or specifically, what does that mean for firms if they, for some reason, can't convert their contracts from LIBOR to whatever the new reference rate is going to be before December 2022, when that FASB relief expires?
Thanks, Mike. It's a great question. And you know, the short answer is that if they don't convert, they won't be able to take advantage of the relief as it currently stands. And the longer answer is it's important to get ahead and to reach out to your counterparties, reach out to financial institutions, to your banks, to you know, everyone in the in sort of the ecosystem, and get the ball rolling on the process, because you know, again, once December 31st, 2022 comes around, and to the extent your contracts aren't modified, odds are you won't be able to take advantage of the relief. So, and as everyone, Peter and Asaf mentioned, it's important to get everyone on board, whether it's your you know, Market Alpha with Pendo and the legal side of it, as well as the accounting side, and to you know, I think Peter may have alluded to this, is going to be some kind of an order as to which banks and institutions will follow. So it's important to address that as early as possible.
Peter, in order, you know, I guess what David mentioned is that, you know, there might be a mad rush for the door per se, you know, as we get closer to this expiration date, right? Can you elaborate on that?
Absolutely, Mike. Is the issue you're going to have here, more so than probably a lot of the other regulations that we've seen so far, you know, over the last 10, 12 years, is this is going to take for your existing trades and securities and everything else, it's going to take at least 2 to tango, right? And if not a lot more. So the problem here becomes is if people get forced into transitioning out of this, just because you are ready and you want to do it, your counterparty has to be on the same page and has to want to be ready as well. So as David mentioned, there's going to be a tremendous pecking order that is going to start happening in the marketplace to transition out of these trades. So just because somebody is your largest counterparty and you would like to get their trades off your books, you might not be their largest counterparty, and you might rank number 15 or 20, in which case they're like, yeah, I hear you, but I don't want to get back to you at this stage, or I'll get back to you when we're ready to move on with you. And I think it's going to be a very important piece of this puzzle, because it is very complex. There is nothing simple. There is economic terms, fallback terms, and everything else. And this pecking order is going to start really causing a lot more trouble than people think. And again, that's why you have to be ready. You have to understand, what is it that you really want to get off your books, right? What do you really have on your books in order to get it off your books?
Yeah, I think on one of your slides, Peter, you posted that there were over 200 trillion in notional tied to LIBOR. So I can imagine what kind of a daunting task that's going to be to convert the majority of those products. I know a lot of them are cleared derivatives, but many of them are not. And like you said, you know, there's going to be a significant pecking order involved in terms of getting up getting those positions converted. So it's a big issue that is going to heat up over the next year or so, for sure.
Absolutely, Mike. And as Asaf mentioned too, right? You might want to transition to one rate, and somebody else might want to transition to a different rate, and you just don't know where this is all going to go. You know, this is why you have to be ready and know that certain trades you do want to get rid of, and others you might be like, look, I can wait a little bit.
Great, and this brings up a question from. I'm actually going to take a question from one of the participants right now. So this is for Asaf. So it was mentioned that the LIBOR transition is a quote unquote DEFCON 1 litigation event. Asaf, I think you mentioned that in your comments. What does that mean? You know, where did that term come from in the first place? And you know, what are the likely litigation scenarios related to the LIBOR transition?
Yes, that's right. I mean, the statement came from the General Counsel of the New York Fed, Michael Held, in a speech. You know, this is part of the regulators urging market participants to get ready, but there's certainly truth behind it. So when we think about potential litigation, you know, one example I already gave, which is in the zombie LIBOR scenario where LIBOR continues for some time in some form, but one counterparty says this is the LIBOR, the other says this is not LIBOR. It may, you know, depends on exactly how LIBOR is defined. It really depends on the detail, but that's one area where you can see disputes. There could be some class actions by consumers. You know, you can think about mortgages, and there's a lot of thought going into how to amend the mortgage documentation. That's in that tough legacy category, because mortgage holders are treated as very sort of delicate group of consumers. They're not sophisticated. They need to be treated a little differently. And you know, when you look at all the legacy contracts, you know, where you don't have good fallback provisions or no fallback provisions at all. So any kind of situation where you have a contract where a situation, especially so material as to what the interest rate is, but the agreement doesn't contemplate that, that's really grounds for disputes. So, you know, you can have, you know, you look at the details. So maybe one party has some discretion to change the rate. Maybe one party thinks they have some discretion to change the rate. So maybe they do, but the counterparty might disagree. You can have some disputes there. Or maybe, you know, the party that has the discretion is better off doing nothing. Maybe it's changed to a fixed rate, but that's good for that party with discretion, if the administrator or the trustee. But the other party maybe thinks they should use the discretion. You could have a dispute there. So this is exactly the kind of situation where lawsuits arise from. You know, take that, multiply that by the trillions, so you can see why DEFCON 1 litigation event is maybe an appropriate term.
And Mike, I would add to that, the fact that LIBOR is still trading like it's not going away, nobody has an excuse. We all know, right? Everybody that still trades LIBOR today and is creating these instruments, the fact that you can still get a floating rate, you know, adjustable mortgage for 5 years or 7 years or 10 years against LIBOR today, that's on the verge of irresponsible right there, right? With no clear transition, you know, language in this to say, hey, by the way, this is going to move. So there's hundreds of those examples. The fact that if you ask anybody, even on this webinar, how many of you and your firm have discussed when's the last day that we're going to trade LIBOR, I will bet you that the answer is 0.00. Very strange.
Interesting, absolutely. And obviously, we also talked about the differences between LIBOR and SOFR, and they're two very different rates. Obviously, there's potentially going to be winners and losers in this transition, and if you're not treated fairly, or you perceive that you're not treated fairly, I could definitely see litigation arising out of that. So this is a very risky you know, prospect coming up with the LIBOR transition for sure. And that actually leads me to another question from one of the participants, and I know we touched on it briefly, but in both Asaf and Peter's slides, but you know, there are a number of different instruments being proposed out there. In the U.S., obviously, the Fed is pushing the market towards SOFR, and there are significant differences between SOFR and LIBOR. I know we touched on it briefly in the slides, but does anyone want to go into any more detail on some of those differences? Now, SOFR is a daily rate. It's set on a daily basis and will probably need to be averaged over time in order to create a quote unquote term rate. LIBOR is set up front and paid in arrears. So does anyone want to go into a little bit more detail about that and just talk about the differences between LIBOR and SOFR and why that's such a big deal?
Mike, I will take this, being the former trader, and this is so close to my heart. I think this is where I truly believe, yes, on the surface of this, it looks very tricky with the way that SOFR is set up today. But I'm also a very firm believer that the market is unbelievably dynamic and that the market will create the new forward rate, and that they will create a forward rate for SOFR that will be published by somebody somewhere, simply because it is required. Is part of the issue for today is that we look at the problems rather than looking for a solution. And I think that as we transition to this October 16th date that I mentioned for 2020, when the CCPs will start moving to SOFR, this will really increase the volume in both the OTC and the futures market for SOFR, and therefore that will gain more traction. And if you have a robust futures and OTC market, then creating the forward rate and everything else will be much more easily done and dynamic. So I do think we will get there.
Excellent, thanks, Peter. And Asaf, go ahead.
Yeah, just one thing to add to that. More generally, things will get more complex, at least in the short term. Some of it is based on the differences between SOFR and LIBOR. For example, if you take loans where corporate treasurers are used to borrowing, based on a forward-looking rate, at the beginning of your term what the rate is going to be, and then you hedge your loan based on a forward-looking rate. But if you start using backward-looking rate, but you hedge in the opposite way, then you create some basis risk. You need to hedge for that. So maybe at least in the short term, maybe the market would settle in the long term. But in the short term, in addition to the different rates out there, those kind of differences create more complexities.
Absolutely, no question. Okay, so with that, I think we have time for just one more question here. So this is going to be a general question. I'm going to ask all the panelists to go around the room and give us your thoughts briefly, because we only have a few minutes. But we'll start with David. But I want to pose this question to all the panelists. So here it is. What do you think will happen after December 31, 2021? What's your consensus opinion at that point?
Thanks, Michael. Well, I think it remains to be seen. I think my feeling is that you're going to have a lot of entities that are and counterparties trying to get this done as soon as possible, and going through the motions of having all of the contracts modified and taken off the books. However, I think to the extent that some of these aren't modified prior to December 31st, 2021, we're going to have, and I think that's one of the reasons the FASB, for example, gave that additional year to allow entities to transition away. So I think from an accounting perspective, at least, there is a cushion that entities have to get their contract modified beyond December 31st, 2021. But again, it remains to be seen. As Asaf mentioned, LIBOR may remain in some form, so it's really up in the air.
Asaf?
Yeah, so right. No one knows. As I mentioned, it does seem increasingly likely that LIBOR will survive in some form for some period. And it's a big uncertainty out there. Some of the market in the US will likely move to SOFR. How big that is going to be is yet to be seen. And I'll mention for the participants themselves, what we can assume is the better prepared you are, the easier it's going to be for you. So if you're fully prepared, this may very well be a non-event for you. But if you're not prepared, this could hit you at some point. So that's an important point to consider as well for each participant individually.
Great, thanks, Asaf. And with that, I'm going to let Peter close it out. What are your thoughts? What's going to happen December 2021?
What I think is going to happen is that before that date, and you've heard me say this many more times, I think the Fed will turn honey into vinegar, and it won't tell you have to get out of LIBOR, but it's going to make it really, really expensive for you to stay in LIBOR. And that expense will force people out of this. How do I think they're going to do this? I think eventually they'll do it through their stress testing, through their CCAR process. Throughout the CCAR process, they can make it for every bank in America, and most of these transactions get touched somewhere along the line by banks. They'll make it really expensive for banks to hold on to these. I think banks will still continue to set some LIBOR, but it will start to dwindle more rapidly as time goes by. And you will have to answer to whoever supervises you as to what is your plan to get out of residue LIBOR stuff you have. Completely agree with Asaf, which is basically you better be prepared. If you are not prepared and you don't have a good plan and you don't know what you're doing and you're going to rely on the fallback language, that is your plan, you're in for a world of hurt. That's a terrible idea. So that's how I will close it from my side.
Great. Thanks, everybody. This was a very informative webinar. We covered a lot of different aspects of the LIBOR transition, but we've only really touched the surface. Obviously, this is a very complex issue. So, please reach out to us if you want a consultation or want to, do a deeper dive on any of these issues as it relates to the LIBOR transition. So with that, thank you, everybody. Thanks for spending, an hour with us this afternoon, and hopefully we'll be talking soon.